Hello viewers, welcome back to our YouTube channel, KC Accountancy Education Center. And today we want to proceed from where we stopped with our series of advanced financial management. And we highlighted in the previous videos the principles of Islamic finance, and those are the ones that we are going to go into detail. We are going to give a detailed analysis of those principles of finance, principles of Islamic finance. Now, one of the principles of Islamic finance is paying interest, paying or charging interest. Paying or charging interest is prohibited. Is prohibited. So the reason as to why it is prohibited or it's not allowed to charge interest is the fact that Islam considers lending with interest payment as an exploitative practice. Lending with interest, payment as an exploitative practice. So given the fact that these people, they don't charge interest, it doesn't mean that these people are actually giving out money for free. No, their argument, we shall see how they treat these, some of the excesses that you pay and how it's determined. So for them, they are saying that lending with interest payment is treated as an exploitative practice that favors the lenders, effective practice that favors the lenders or the banks, that favors the lenders at the expense of the borrower. They favor the lenders at the expense of the borrowers. It's like they cheat the borrowers. That's how they look at interest. So here in Islam, interest is treated as riba. So for them, they treat interest as a riba. For example, if let's say a bank that has, because most of the times what happens in these banks, especially in developing countries where Islamic banks have just started emerging, what happens is that we always have a commercial bank or a conventional bank. That commercial bank, like we can use, let's say, Standard Chartered Bank, because I heard they have some window for Islamic finance. So if what happens is that the bank is going to have two windows, the Islamic window, then the normal business window. The normal business window. So this window is only going to be looking at Islamic products alone, and they are going to be lending out money not to Muslims alone. No, the principle operates even to those that are not Muslims. But the application of these principles, they are the ones that keeps the Islamic finance different from the conventional banking products. So what happens is that this side, they don't charge no interest payment, because they call the interest as riba. So this side we charge interest. The normal commercial banks, they charge interest on whatever amount that you've borrowed. But what these guys are saying, if you are that bank, because Standard Chartered Bank has two windows, the window for this Islamic finance and the normal retail and business trading business. Now, what happens is that you are going to have Islamic products, and you are also going to be having these other non-Islamic products. We shall look at the products. And those non-Islamic, or those other products that you are going to be selling to your customers, you are going to be charging interest. They are going to be charging interest. But now, what happens is the fact that if it can happen that maybe you have established your bank. Let's say we are going to go with the recent example, that is Salam Bank. Now, it's going to happen. There are situations where you may be tempted to have two windows, where you have the Islamic window and also the other side. I don't know much about the operation of this, but I know they are giving out Islamic products. They are Islamic products. I'm not sure whether they are actually providing two. But for a scenario whereby you are providing two items, it's going to be problematic in a sense that the board, if let's say you're a business and you want to go and borrow money, these people, the bankers, shareholders, they may be saying that for them, they may be interested in just giving out Islamic products, but you are going to find that the kind of operation, it may not be sustainable for you to sustain the business. So that's why sometimes if the Islamic products, if a bank is running two products, it means the shareholders may be interested in having the Islamic products, but at the same time, they're also having the other point of view. So this Islamic side is also going to be governed, or they are going to be using Sharia law to regulate its operation, that Windows operation. But now, if the shareholders entirely recommend that let the bank use Sharia law, even if you have two windows, but we go by Sharia law, what is going to happen is that the interest that you have made from this normal trade, which are not in the Islamic products, you are going to be forced to actually give out that money of the interest you charge, because they call it riba. It's not allowed. So if you charge interest, then the treatment, the regulators, we shall look at the regulators, they will make sure that you don't charge interest. So if you charge interest, that money you have charged in interest will be removed, or you will be forced to donate that money to charitable organization and other kind of people, depending on how. Most of the times they donate that money to the charitable organizations. So you may be having two windows, the Islamic window and the other window. The other window, you may be charging interest, purely charging pure interest, the same way that these other conventional banks are doing. But what is going to happen if the shareholders of that bank are totally in agreement recommending Sharia law for their bank. Even if you have two windows, the interest you are earning from the other non-Islamic products, they are going to be sent out or donated to charitable organization because of the fact that interest is 100% prohibited. So that's what we refer to as the principle of charging interest being prohibited from the Islamic products. The other is just like how interest is prohibited under Islamic finance. We also have prohibited activities. Prohibited activities that even if they give you money, maybe you have received a bond from an Islamic bank, we have an equivalent for the bond. There is what they call it. We shall look at those types. If you borrow money from an Islamic bank and their regulation is actually using the Sharia law, then that money shouldn't be invested in these prohibited activities. So when they give you money to go and invest, then you are not supposed to invest in those prohibited activities. So what are some of those prohibited activities? One, we have alcohol. Maybe you're a brewing company, they can't give you money. Drugs, of course, drugs like narcotics, and others. We have also gambling activities. These people who operate betting companies. We have also pork, those that are involved in piggery, things to do with pornography, and others. These are some of the activities that are prohibited, that even if they give you the money, you are not supposed to invest the money they have given to you in those activities. So if you borrow money in any of those Islamic banks, you are not supposed to invest that money in prohibited activities. But you have to be careful. It could be an Islamic bank, but it is operating a conventional business, meaning they are not issuing Islamic finance products. So as long as you confirm that this business is actually separately providing products of Islamic finance and they are being regulated by Sharia law, then we can say that that money shouldn't be invested in those activities. So those Islamic banks, most of the times, those companies, most of the times they are in those Arab countries, Saudi Arabia, UAE, most of the times, because those banks, they are very big that side. And banks in those areas, they mainly provide Islamic products. But it's unfortunate in Uganda we have very few which have just started because of different aspects. And the reason is not because we don't want them to exist, but even the regulation itself. Of course, we are going to look at the regulatory authorities, but Islamic products, they are supposed to be supervised by a Sharia law council, of which we may not necessarily, like for a given country, they may not necessarily be having those people that can spearhead those kind of supervision. They can, if you don't have those people, of course, we are going to be looking at what are the members, what are they supposed to be having. So if those people are not there, then you don't actually expect those businesses to run. And maybe that's the reason as why it took long to kick off in Uganda. But at least we have seen some coming up. So that's one way. And these prohibited activities, for them, they call them haram. That money came from drug, money came from gambling, money came from operating pork joints, pornography, alcohol. So they call that money, it's haram, because it came from the prohibited activities. So this haram is just an Islamic word, and I think even those who speak Swahili, this one must be, there's a meaning some in those that speak Swahili. If you know the meaning in Swahili, please just put the meaning in the comment section. But just know these are activities that are prohibited, and you can't use Islamic finance products to finance the activities of those businesses. So the same way, maybe we deal with the interest is the same way they deal with these prohibited activities. They are not supposed to be involved in those activities. Now, the other is no speculation. So Sharia law is strictly prohibiting any form of speculation, whether it is gambling, whether it's betting, with whichever, as long as something that involves speculating, you are not sure of the outcome, but you are doing it as a business. So they call it mysil. I don't know the pronunciation, but I think mysil, MAISIR, mysil. These are just words, but just get the meaning from the English perspective. So some of these, like I've said, for the betting companies, of course they don't qualify, given the fact that their kind of work is more of speculations. There are chances, there are probabilities, you are not sure of the occurrence. So gambling and other kind of stuff. So there are also there is also a kind of speculation whereby the wholesalers, they buy products in large quantities and they hold those products. They don't sell them to the people, hoping that these prices will actually go up. So that kind of involvement is not allowed, because that's one way of speculating, because you are keeping the products so that you create scarcity and you'll be able to sell as far as the price has gone up. So that kind of speculation, where the thing of trading, forex trading, you anticipate maybe the dollar will move up, you buy, then you keep selling. Those kind of business, those are speculative businesses. So speculation is not allowed. They call it mysil. So what is going to happen is that most of the time we say, remember, these are going to be cases. They may mention these words, mysil, in the case, haram, riba. So you just have to know what they mean in English. Then you'll be able to explain. You are not supposed to explain in Arabic. But as long as you understand what it means, then you can be able to explain based on the scenario that they have given you, because you may find this in a scenario or in a case study. So you have to just know what it means and you explain, and that's all. Therefore, these Islamic financial institutions cannot be involved in contracts where the ownership of goods depends on uncertain event in the future. Just like these things we do in accounting, because we account for option contracts. Those when you're dealing with the futures, those things, they are not allowed. We shall look at these option contracts and futures maybe when we go to the other side of hedging interest rate, hedging some. That's where we shall look at some of those different aspects, because those that are going to be involving predicting, because you can have a contract and they are telling you maybe you are buying goods from outside, overseas, maybe from Japan, raw materials, and you are not supposed to pay in Ugandan currency, maybe you are supposed to pay in the dollar currency. You can fix the dollar that I'm signing an agreement. By the time you ship these products and they come to me maybe in 4 months, I will be paying you at this fixed rate of the dollar rate, the currency rate. Because if you don't do that, the dollar may keep on changing. You get an order and they tell you the dollar you are going to pay maybe 20 million. But due to exchange rate, you find that by the time the goods come to your side, currencies have increased and you are going to be paying more money than what you should have paid if at all you had to pay at the time when you made an order. So those kind of hedging, those kind of risks in forex, those are more of speculation. So these kind of things you are hearing me talking about, hedging, things to do with the option contract, they may give you a scenario and it is just talking about those. Then they explain, they tell you to identify the principles, but they are just giving you examples of these. So the case is going to be rotating on some of these aspects. So the things to do with the hedging, we shall learn more about it. We shall do hedging and we shall see how we hedge against some of these risks. And some of the tools that we use, those are the ones that we call futures. We have what we call the swaps. We have traded options. We shall look at some of those and others. So therefore, these are more like speculations, and we are not, because you just keep on fixing and you are not sure of what will be the outcome. So those kind of scenarios, they are not allowed, because you are not going to be sure of what is going to happen by that time. So you are just hoping by that time, maybe if I come up with this contract, then this is how we shall manage the risk, etc. So such aspects or such activities are not allowed in Islam. Then we look at the other we have uncertainties and risks is also another principle. And the rule of Islamic finance banned the participation in contracts where the terms and the subject matter are uncertain. They tell you we sign a contract, maybe we expect that maybe we are going to win. You bet. So when the terms of the contract and also the subject matter, there's something that you are putting your money against, is not sure. You are going to borrow money, but you are not sure whether you are going to make a profit or you are going to make a loss. The subject matter is not clear. So if it is uncertain and it has excessive risks, then this is also going to be prohibited. This aspect of uncertainty and risk includes prohibition on selling something that's like you try to sell something that you don't own. You are selling something and you don't actually own the thing. Like those things we do, like the things that we do in accounting, these derivatives, which are more like gambling, where you are involved in trading something even when you don't own it. Even there are these brokers who actually advertise that they are selling land when they actually don't even have the land, but they are just connecting people. I know the other one is selling, so let me get the buyer. That kind of activity. And you tell the buyer that the property is actually yours when it is not actually yours. Those kind of transactions, they are the ones that because you are not sure of the event that is going to come out. So the other principle of Islamic finance is that risk should be shared. Risk should be shared. Of course, we are aware that in business, even the Islamic banks, they are aware that in business there are risks that are involved. Therefore, in Islamic finance, the partners will share the profits, and at the same time they will share the losses according to the part they played in the business. If we come together and we do business, we make a loss, we share that loss in the way that we became part of that. What, like, you share what you contributed according to how you contributed to that loss. But we are not supposed to say that we are going to be sharing these losses equally. No, we share according to our participation, if at all that is a business. So it's according to how you are in the business. If I bring in capital, if I'm the bank, I'm the Islamic bank, and I give you money, you make a loss, there is no way you can tell me that we are not going to share losses, because I didn't borrow your money to actually go and make losses. The intention wasn't to make loss, but I made a loss. It's different from the conversion. The other side, the commercial banks, if you make a loss, it's your loss. For us, we gave you our money, return the money. But now these ones, they also add in something that they don't have guarantee on returns. If you come together to do business, then there are possibilities that you may actually not get the profit. So there is no guarantee that you are going to earn a profit. So no guarantee on the returns. Therefore, there are risks, but of course they recognize the fact that there are risks that are going to be in the business, and they are going to be shared between the lender and the borrower. For example, if let's say I have lent to you, if the bank lends me, let's say 20 million, if they have given me 20 million, and maybe for me to go and invest in, let's say, a bookshop, but before the bookshop starts, the money is stolen. Before I start even doing anything, the money is stolen. So what will happen according to Islam? The risk must be shared, because I never intended to actually let this money be stolen. So the money, the loss will be shared. And at the same time, if we start a business, if at all money is not stolen, I've started a business and I've made a loss, then that loss is also supposed to be shared, because my intention for me to join business wasn't to make losses. So you shouldn't penalize me because I've made a loss. So that's why they are sharing these losses. And if you make a profit, then it's also going to be shared. It's more of a partnership. So the logic here is that when money is stolen or the company has made a loss, the loss must be shared because no one expected it to happen. And that's why they were restricting us from investing money in those uncertain activities, so that we invest in legitimate trade, legit, something you are sure you are not just throwing money. And that's why you can be able to benefit. But there are scenarios that I can give you money and you invest in those prohibited activities and you expect us to share the loss. That won't happen. So that's why they are saying you share the loss based on how you involved. If you're the one who actually made that loss, or maybe you are the one who stole the money by yourself and you start saying that the money was stolen, then it will be upon you. Now, the last one that I want to look at is the other principle is wealth must be generated from legitimate trade, and it's supposed to be asset backed. It's supposed to be backed by an asset. So they are saying that wealth must be generated from legitimate trade, and it must be asset based. It must be asset based investment. In other words, we don't have money on money transactions like what happens with the lenders. They give you money and you go and do any business you want, then you bring back their money. No, these people, they tell you, if you want to buy, if I'm borrowing money to buy a car, it will be the bank to go and pay the bond owner, the car owner. Then they give me the car. Of course, they pay the other car, they buy for me the car, and they give me the car, then I start paying money. But I'm going to be paying the amount that they have spent to buy that car. Secondly, we may agree to add in some extra amount just to take care of the administration costs that are going to be incurred. But that is going to be on agreement that I'm buying for you a car of worth, let's say 50 million, but in return for you will be paying 55 million for a given period of time. So you will be paying that knowing you have agreed and you have accepted that the other 5 million is coming in to just necessitate the operations of this business. But it doesn't necessarily mean that these guys are going to give you 50 million and you give them 50 million back. No, that's not how it works. But that's how it seems to be, because the other cost that they are going to charge you is like a nominal cost. They add in that just to cater for these extra expenses that may occur, because they can pay a motor vehicle for 50 million. But remember, there are other paperwork, transferring the logbook and other costs. So you'll find yourself on top of the 50 that they have paid the car owner, you will be ending up paying more, but that amount is supposed to be agreed between the two of you. So therefore, those are some of the principles that we are going to see here. So I want us to look at, in the next video, we look at the regulatory framework for Islamic finance. We look at how it's going to be regulated. What are the parties that are involved? So let's meet in the next video as we are looking at the regulatory framework.